I do think that there is a much greater chance that inflation will rise again in the next year or two. And because of all the money that's flooding into the market, I think there will be more inflation no matter what happens in the job market. That's exactly what I expect, especially since there will be growth in assets. If you want to keep yourself safe from inflation, in the short term, I would say gold. In the long term, I would say Bitcoin. James Lavish starts the conversation by talking about how the market is always guessing how the Federal Reserve will change its monetary policy. Will the Fed keep cutting rates quickly, or will it be more cautious and only cut rates by 50 to 75 basis points by the end of the year? Some people in the market are hoping for bigger cuts, but Lavish is not sure. Not believing that a 100 basis point cut is possible, he talks about what Fed Chairman Jerome Powell said recently, which said that the fight against inflation is almost over. He uses the PCE index number of 2.2% to show this. Lavish makes it clear that Powell's focus on this number might be off, because the core PCE, which gets more attention, is 2.7%. Powell's choice to focus on the lower number could show that the Fed is becoming more worried about unemployment going up. Lavish says that the change in attention from inflation to employment points to a bigger worry, the chance of a big rise in unemployment that could cause a recession. You can also watch our other videos about cryptocurrencies and digital assets in general. Please share your thoughts and comments in the part below. For the channel's growth, everything you do is very helpful for the YouTube system. Thanks and have fun with the movie. The market isn't sure if it wants to reward higher prices or more rate cuts from the Fed. Is it hoping that the Fed will cut rates again because of bad economic data? That means the Fed will cut rates even more quickly. Again, the rate will be cut by 50 basis points. After that, it could go down by another 75 basis points or even 100 basis points before the end of the year. I don't believe that. I believe 75 basis points is a large amount, but that is the first one. We heard from Powell a few weeks ago that the fight against inflation is almost over. He showed a number that was 2.2%, which is the PCE number for inflation. That's not the main PC number. 2.7% is the core PC number. That didn't bother him, so he turned his attention to a number that doesn't normally get his attention. He usually looks at the PC core number, but this time he said, oh, it's just 2.2%. What were they thinking? For the same reason that Mike mentioned, they are worried about unemployment. According to what Anna Joan said this morning in the meeting, there is a chance that unemployment will rise. Okay, I agree. Now everyone is looking at these things like keeping an eye on unemployment and hearing what the Fed has to say. When we talk about that 100,000 foot level, what do we mean? The question we're asking is whether the market will still credit bad news, or whether it will now shift to the other side and say, oh, this jobs report is so bad that we're going to slip into recession. It's not going to be stopped by the Fed. It's not going to get better until the Fed pours more money into the system. This means that we will have to go through some pain before they step in. It will have to drop by 10 to 15% or even more before the Fed and the Treasury will step in and start putting money into the markets. If it does, it will have an effect on the credit markets. What we're really seeing is that we're on the verge of that strange situation where bad news is good news or bad news is bad news. It seems like a trade to me to own a long bond since you're looking at this. At the end, you think about the rate going up to 3%. Long notes, on the other hand, will be much higher than that. You'll have higher rates for a longer time because I think there's a much higher chance of inflation coming back over the next year and a half, and because of all the money that's pouring into the market. So how much money are you going to make between now and then? I think you need to cut your losses. This is going to happen no matter what happens in the job market. I think there will be more inflation. That's exactly what I expect, especially since there will be growth in assets. If you want to protect yourself against inflation in the long run, gold is probably the best choice. Yes, I would say Bitcoin, but that's a matter of personal choice and capital allocation. But I agree with Mike. And now there's a pause. And even then, if you look at gold during the Weimar era, just look at how unstable it was. You do have that chart, right, Scott, how gold changed a lot during the Weimar era. I mean, it was really unstable. It happens all the time when people aren't sure what will happen, especially when they don't know if hyperinflation will happen. I don't think the US dollar will go through hyperinflation anytime soon. That's just my view. There's no way I think it will happen. It is the world's main currency. Everyone in the world has way too much faith. It's not likely that hyperinflation will happen in the next few years. It doesn't make sense to me. If you compare the last 3 months to the last 12 months, you can see that worldwide liquidity has grown by about 5% or 5.1%. When you look at the last 3 months, though, it's over 11% if you look at it that way. To add to Dave's point, this is why these guys are rock stars. That's why everyone is interested in central banking. That's why they pay attention to the bankers. They are trying to figure out where cash is and where it's going because this is the most important thing for markets. This is because the world is so financialized and leveraged that this is the most important thing. What's the amount of cash in the system? Is it getting added to or taken out? Because you can't keep growing without taking on more debt. That's just how things are now. That's why these guys are concentrating on it. As we already talked about, another thing is trying to figure out where the Fed is going. One part of this is how much they are going to cut rates. Well, if you look back at the Fed dot plot, Mike can see this on his Bloomberg screen. If you remember the last meeting, the cuts were, Fed officials thought they would go down below 3%, but now it looks like the final rate will be 3%. This means that Fed officials think the neutral or final rate is around 3% and will try to get there as soon as possible. So that's what I think will happen. Yeah, that's just next year. I think we'll try to get there this month. That's the truth. Next year we'll try to reach 3%. We have a bigger problem if we cut more than that. That's when the other tool will really come in.